Welcome back to the Plan Future Insight. I am Investment Dada, and today, we are going to talk about a question that separates the wise from the restless. What are the real risks in the stock market, and how do you protect yourself from them? Let's start with a simple truth. Most people only worry about the market falling. But after 20 years of watching investo rupees, I can tell you that is only half the story. There are two real risks you need to understand, and the second one is far more dangerous. First, there is market risk. This is when the entire market goes down, not just one stock. Think of the global crisis in 2008 or the pandemic in 2020. Your portfolio might drop by 15 to 30% in a few weeks. It feels terrible, but here is the beautiful part. This risk is temporary. In 2008, the Nifty fell by about 60%. But by 2013, it had recovered and was up 80% from the bottom. For a long-term investor with a regular SEEP, this is just a buying opportunity. Imagine this. A 10,000 rupee SEEP started in January 2008, right before the crash, would have grown to over 1 crore rupees by 2026 at a 12% CAGR. If you panic and exit, you lose. If you stay steady, you win. Now, the second risk is emotional risk. This is the silent wealth destroyer. It is your own fear and greed. How does it feel? You see a 30% drop in one day and sell in panic to save what is left. Or you buy a hyped stock at its peak just because everyone else is buying. Dada's take is simple. 90% of underperformance comes from timing error. Rupees investors who stay the course through volatility win. The regular advantage is this. A mutual fund distributor is your emotional firewall. They call you when the market crashes and say, "Stay put, this is normal, your goal is still 15 years away." They prevent you from making the biggest mistake, selling low. Then there is concentration risk. This is putting all your eggs in one basket. The mistake is buying only one sector, like information technology in 2022, or only one stock. Dada's rule is never have more than 5% of your portfolio in a single stock unless you are a professional. Use regular mutual funds for instant diversification across 40 to 60 stocks. Finally, there is inflation risk, the silent erosion. The danger is keeping all your money in a fixed deposit that gives 7% while inflation is 6%. Your real return is barely 1%. Dada's solution is equity. Over the long term, equity is the only asset class that beats inflation consistently. 1 lakh rupees in a large cap regular fund for 10 years at 12% CAGR becomes over 3 lakh rupees, outpacing inflation. So what happens if these risks hit you? If the market crashes by 30%, your 1 lakh rupees becomes 70,000. Do not exit. Continue your SEEP. The next 2 to 3 years will recover it and then some. If you panic sell, you lock in the loss forever. Your mutual fund distributor prevents this. They remind you of your 15-year goal. If you concentrate in one stock and it falls 50%, that stock becomes 50,000. Your whole portfolio suffers. Rupees a regular mutual fund owns 40 to 50 stocks. No single company can break your wealth. If inflation runs at 6% for 10-year rupees, your fixed deposits 1 lakh rupees is worth only 55,000 in purchasing power. An equity SEEP is your inflation-beating shield. Now, here is what you can do this week. First, build your foundation. Before any stock or fund, ensure you have an emergency fund covering 6 months of expenses in a liquid fund. Get term insurance worth 10 to 12 times your annual income. And have health insurance of at least 5 lakh rupees. Second, start small and stay consistent. Begin a SEEP of 5,000 rupees per month in a regular large cap fund. Use the automatic route, set it and forget it. Your time horizon should be at least 7 years. Rupees for 5 years or less, use debt funds. Third, get a financial bodyguard. Connect with a mutual fund distributor. They are your guide through the storms. They will prevent you from making the mistake of a lifetime, panic selling. Dada's wisdom is this. The stock market has a wonderful way of transferring wealth from the impatient to the patient. The biggest risk is not a crash. It is your own fear. A regular SEEP through a trusted mutual fund distributor turns that fear into discipline and panic into profit. Remember, investment in the equity market is subject to market risk. We do not claim any guarantee of return in equity-related investments. Past performance is not indicative of future results. You have the courage to ask the right questions. Now, go out there and build your future with confidence. This is Investment Dada, signing off. Until next time, stay wise and stay invested. Thanks and regards, Kaustav Bishwas from Plan Future, welcoming you to visit our website. Data and AI driven, your personal navigator and co-pilot for investment analysis.